Hello, today we are looking at an introduction to income tax. Let's have a look at an introduction. Income tax is charged on individuals, trustees and personal representatives. There is no minimum or maximum age at which tax liability can arise, although in practice few children will have sufficient income to have to worry about this point. If you are resident in the UK, then you are taxable on your worldwide income wherever it arises. If you are not domiciled but resident in the UK, you can currently claim something called remittance basis, so that you are not taxed on your overseas income if it's not brought into the UK. This is being abolished with effect from the 6th of April 2025 and being replaced with another regime, much narrower. If you are not resident in the UK, then you may be taxable on income which arises in the UK, so-called UK source income, but this will be subject to provisions of double tax treaties, which are agreements that the UK government have entered into with other jurisdictions about the taxation of various sources of income and gains. Spouses and civil partners are treated as independent taxpayers, so we tax them separately. The final point to note is when we are talking about residence in the UK, this is determined by looking at something called the statutory residency test. We're not going to be covering that today, but it is important to note that there is a specific set of rules governing whether or not someone is resident in the UK. Income tax is charged according to the source of the income, with each source of income having its own rules for calculating the profits. Income tax is charged for the tax year, which runs from the 6th of April in one year to the 5th of April in the next year. So we are currently in the 24-25 tax year, which runs through to the 5th of April 2025. In addition to each source of income having its own rules, there are some standalone charges, and then there are reliefs to consider which may reduce the taxable income or reduce the tax payable. We're going to go through this series of rules as we go through this session. The legislation gives us a series of steps as to how we calculate the income tax liability. Now, in practice, most people will have software that does this calculation for them, but it is quite useful to understand the basics of the calculation. So step one is to identify the total income, which is the sum of the different components. So what we mean by that is that if you have trading income, property income, interest, dividends, and so on, we just work out the profit from each of those sources and then add them together to give our total income. Step two is to deduct any relief which is given against net income, and that would cover things like loss relief, interest relief. And then step three is the deduction of any allowances to which the taxpayer is entitled. Now, the one that we will be most familiar with is personal allowance, but there are one or two other allowances as well. We are going to look at all of these issues in a little bit more detail as we go on. Now, the allowances can be allocated against the income in the way that gives you the greatest relief. And again, software will normally do that automatically. Step four is to then calculate the tax that is due on each component. Now, different tax rates do apply to different types of income, and so we do typically separate the income back out again and work out the tax liability for each of those components. And then step five is to just add together the tax that is then due altogether. Step six then allows us to reduce that tax liability for any reductions that are given in terms of tax. So that would be things like residential property interest relief, EIS or SEIS relief, double tax relief, and so on. And again, we'll look at those in a moment. And then at step seven, we add in any tax due under a standalone provision. So that covers things like the high income child benefit charge, There aren't very many of those, but there are things that we come across on occasions. So that will then get you to a figure, which is the amount of tax that needs to be paid over for the relevant tax year. So there are different rates of tax for different sources of income, but most of them are split up into basic rate, higher rate and additional rate. Non-savings income is taxed at the main rate of tax. Savings income is taxed at a different rate, interest at the savings rate and dividends at the dividend rate. If we move on to this slide, we can see the current rates of tax. Now, it should be noted that these do not apply in Scotland. The Scottish Government and the Welsh Assembly have the ability to raise different rates of tax. Only the Scottish Parliament have exercised this right, and we will look at the Scottish rates of tax in a moment. Currently, the basic rate of tax for both the main rate and the savings rate is 20%. The higher rate is 40% and the additional rate is 45%. For dividends, the basic rate is 8.75%, the higher rate is 33.75% and the additional rate is 39.35%. £5,000 of interest income may be taxed at 0%, but only if your taxable non-savings income is less than this. So if you have other income which takes up that first slice of £5,000 of taxable income, then your savings income is not taxed at 0%, it would just be taxed at the savings rate. And the other point to note is that trusts always pay tax at the additional rate of individuals if you are a discretionary trust, unless no income tax liability arises. So let's have a look at the allowances that are available. The personal allowance is currently £12,570, and that applies for persons who have income of less than £100,000. Once you get to income of £100,000 or more, your personal allowance is reduced by £1 for every £2 that your income exceeds this threshold. The higher rate threshold is the point at which you move from paying basic rate to higher rate tax, and that is currently £37,700. And the additional rate threshold, which again is the point when you move from higher rate to additional rate, is £125,140. There is a personal savings allowance of 0% for interest, and that is £1,000 if you are a basic rate taxpayer, £500 if you are a higher rate taxpayer, but you wouldn't get any personal savings allowance if you were an additional rate taxpayer. And there is also a dividend allowance where again 0% tax is payable, and that applies to the first £500 of dividend income, and that applies to everybody regardless of your marginal rate of tax. Now, in some situations we get what is called extension of the rate bands. So things like personal pension contributions and gift aid are treated as if basic rate tax relief has been given at source. So if you were to pay £80 to a charity and you ticked the box to say gift aid was available, the amount of that donation is treated as £100 because you've got your 20% basic rate relief, and the charity would claim that £20 back from the government. Now, if you are a higher rate taxpayer, you actually get your higher rate relief by extending the rate band. So you would add that £100 so that your higher rate threshold would be 37,800 instead of 37,700. And that does give you the higher rate relief. And it would, if you were an additional rate taxpayer, you would also get an extension of the additional rate band as well. As I said before, the Scottish Parliament have exercised their right to have different rates of tax. And this slide shows the Scottish income tax rates for 25-26. This only applies to non-savings, non-dividend income. So if you are a Scottish taxpayer that has interest or dividend income, then you are going to be paying the rates applicable for the rest of the UK. These rate bands assume that you have a personal allowance available, although in Scotland the personal allowance is also wasted away if you have income over £100,000. As you can see, the rates of tax in Scotland for main rate income goes from 19% to 48%. There are more significant rate bands. 2 additional points on allowances. Non-residents may be entitled to a personal allowance, but it will depend where they are resident or where they are a national. There are other allowances available, such as married couples allowance and blind persons allowance, but these would apply to a very narrow category of taxpayers. And 10% of the personal allowance can be transferred between spouses or civil partners, subject to additional conditions being met, but this can only apply if neither party is paying higher rates or additional rates of tax. The next step is to consider the reliefs available against general income. So these would cover things like loss relief, qualifying interest payments, or irrecoverable peer-to-peer loans. The most important thing to note about this is that there is a cap on some of these reliefs, with the cap being the greater of £50,000 or 25% of your net income. Again, as we mentioned earlier, some tax relief is given by way of a tax reducer, and this includes enterprise investment scheme or seed enterprise investment scheme relief or venture capital trust reliefs, relief for the transferred personal allowance, interest on residential property purchased to rent out, top slicing relief, which is something relating to chargeable event gains, and double tax relief where you have paid tax in both the UK and overseas. Now let's just think about EIS relief, for example. EIS relief is given at 30% of the investment. So someone who invests £10,000 in an EIS company would get a tax reducer of £3,000, which would simply reduce their tax liability for the year in which the investment is made. And then finally, we have what might be called the Step 7 tax charges, which are charges which are calculated on a standalone basis and then added into the tax liability. Apart from the high income child benefit charge, this is not common. Gift aid if you've paid insufficient tax, pension scheme charges, and currently transitional charges for changes in basis period. We're going to talk about this later. Let's just go back to the high income child benefit charge, because this is something that you may come across. Where a person is entitled to child benefit, but either they or their partner has adjusted net income above the relevant threshold, then they may be liable to what is called the high income child benefit charge. The adjusted net income is their net income reduced by gross gift aid and gross personal pension contributions. The current threshold is £60,000 and the rate of clawback, so the benefit charge, is 1% of your child benefit for every £200 that your income exceeds the threshold. Now, as we said before, spouses and civil partners are treated as independent taxpayers, but there are situations where we do need to consider the situation, and that is where they have jointly held property. So let's just say they have something like a house which they rent out, which they own 50-50. Regardless of what the underlying beneficial ownership is of that property, the income will always be split 50-50. So if you had a property owned 80-20, the default would still be that it was split 50-50. However, if you wanted the income to be split 80-20, then you could complete something called a Form 17, and that would allow the actual beneficial ownership to be split differently. There are some exceptions to this. So for example, if you have a formal partnership or where you have jointly owned shares, but it is something to be aware of. Now let's have a look at the different sources of income. Trading profits arise where somebody is carrying on a trade, profession or vocation. And effectively, we take their income derived from trading activities and then we deduct allowable expenses which have been incurred wholly and exclusively for the purposes of the trade. Capital expenditure is not allowable as a direct deduction, but you may be able to get relief for capital allowances purposes. If your trading income is less than £1,000, there is something called the trading income allowance. And if your income is higher than that, then you may still be able to get a deduction for that amount. Trading profits arising overseas can still be taxed in the UK to a UK resident individual. And somebody trading overseas, of course, may be subject to double tax, but they should get double tax relief. When we decide whether or not someone is trading, we look at the badges of trade. And it's not always going to be immediately obvious whether somebody is actually trading. Now, these badges of trade have been established through decisions made in the courts. They will look at things like a profit-seeking motive, how many similar transactions you've undertaken, the nature of the asset, whether you are undertaking similar trading transactions. Have you made any changes to the asset to make it more saleable? Have you sold it in a method which is more likely to show trading? How are you financing your apparent business? How much time has elapsed between you buying an asset and selling it? And how did you acquire it? It's a very, very complicated area, but there will be some situations where someone is acting in a way which does not amount to a trade. And in that situation, their income may not be taxable. Now, basis period provisions have recently changed. From the 24-25 tax year onwards, the profit which is taxed in any tax year is the actual trading profit for that period. So from the 6th of April to the 5th of April. Before this, there were more complex basis period provisions. If you have made a loss in a trade, then you may be able to offset it against your general income, either in the current year or the previous year, or you can carry it forward to offset against future profits. And there are special rules relating to some trades. So for example, if you are a farmer or you are a creative artist, you may be able to average your profits. And there are also special rules for things like the construction industry. Property income arises where someone is generating income from the exploitation of land. It can include things like casual letting, and it is divided up between the UK and overseas property. The profits are calculated in the same way as trading income, so income less allowable expenses, no allowance for capital expenditure. The exception to that is where you have interest on loans taken out to purchase residential property, and as we have already noted, you get tax relief for these using a tax reducer. Special rules have applied in the past and currently apply for furnished holiday let businesses, but these will be abolished from the 6th of April 2025. If you are renting out a room in your house while you are still in occupation, so if you have a lodger, then rent-a-room relief may be available, which is worth up to £7,500 per year. If you make a loss on a property business, then that would simply be carried forward to offset against future profits. Other investment income covers things like interest and dividends. You are taxed on the income received in the tax year with no deduction for any costs. It also covers things like annuities, income from deeply discounted securities or the accrued income scheme, which are certain types of investment products, and also covers chargeable event gains on partial or complete encashment of life insurance policies. The final one to look at is earnings from employment. Now, employment is not defined, and there may be circumstances where you need to consider tax cases to distinguish between whether somebody is employed or self-employed. But earnings are taxed when they are received, and the employer has to operate pay as you earn and will be deducting tax and indeed national insurance contributions at source. The definition of what constitutes taxable earnings is a very wide definition. It includes things like salary and wages, but also benefits, amounts received from third parties, and also amounts received in relation to what are called employment-related securities. Again, it is another complex area. There are some exemptions and there may be deductions available in some circumstances. Okay, so that brings us to the end of the session, but we have a quick recap quiz. Please pause the recording to consider these questions and then come back to get a debrief of the answers. The first question is, what income is taxable for a UK resident? All worldwide income is taxable on a UK resident. Currently, at the time of recording, this is subject to remittance basis, but this will be unavailable from the 6th of April 2025. Second question, is the personal allowance always available for a UK resident individual? If your income is above £100,000, then you will lose your personal allowance. As we stated before, the personal allowance is reduced by £1 for every £2 that your income exceeds £100,000. And the final question is, what kinds of relief are given by way of a tax reducer? So EIS, SEIS and VCT reliefs, top slicing relief on chargeable event gains, double tax relief and interest for purchase of residential property. Thank you for your time today. I hope you found this interesting, and goodbye.